ಎಲ್ರಿಗೂ ನಮಸ್ಕಾರ. In this video, let us discuss about working capital management. Working capital management, as you all know, one of the very important functions of financial management, like investment management, capital structure decision, dividend decision, and working capital management. What I mean by working capital? See, to run a business, the business has to invest both in current assets and current fixed assets. Investing only in fixed asset is not enough to run the business effectively. So for that sake, it requires the company need to invest even in working capital or current assets. For example, to meet the day-to-day expenses like wages, salary, purchase of raw materials, or for any other day-to-day expenses, company need to invest some amount in the form of current assets. Say for example, in the form of cash in hand or cash at bank or bills receivable or debtors or inventory. So if the investment in these assets is very less, in such cases the company would face the problem of liquidity. As you all know, what I mean by liquidity is, liquidity means the ability of a company to repay its obligations on time. Suppose if the company doesn't have enough amount of investment in the form of current assets, in such cases the company may fail or the company may find it difficult to repay its obligation. Say for example, current liabilities, then the company would face the problem of liquidity, or like the company would lose its goodwill or reputation among the minds of or in the minds of creditors and all other stakeholders. So therefore, working capital management plays a very important role in the progress and success of a company. Now let us discuss the meaning of working capital. So it is the capital of a business which is used in its day-to-day trading operations, calculated as the current assets minus current liability. As I mentioned earlier, it is the capital required for a business to run its day-to-day trading operations or trading activities, and it is calculated as current assets minus current liability. So working capital is a measure of company's liquidity, operational efficiency, and its short-term financial health. See, working capital is a measure of company's liquidity. Liquidity means its ability to repay its obligations on time. Operational efficiency, how good the company in its operations. Okay, see, operational efficiency depends upon its investment in the current assets. Then short-term financial health. See, short-term financial health depends upon the net working capital or working capital. If the company has competent enough to repay its obligations, such companies, they find it very easy to get the required financial assistance from the financial lenders or the lenders. If a company has substantial positive working capital, then it should have the potential to invest and grow. Okay, now when the company has a substantial amount of investment in the form of current assets, so such companies have the potential to invest and grow. If a company's current assets do not exceed its current liabilities, then it may have trouble growing or paying back creditors or even go bankrupt. I've already mentioned that when a company doesn't have enough amount of investment, when its current assets are much lesser than current liabilities, such companies may go for bankrupt, or it is very difficult for them to grow or to pay the creditors. So therefore it will affect very negatively to the goodwill and image of the company. Now let us see what are the components of working capital. So working capital calculation, you know the formula, current assets minus current liability. So therefore the components of working capital contains current assets and current liabilities. So first let us discuss current assets. So what do you mean by current assets? These are the assets which in an ordinary course of business can be or will be converted into cash within 1 year without undergoing a diminution in its value and without disrupting the operations of the firm. See, for example, inventory, sundry debtors, cash and bank balances, loans and advances, short-term loans and advances, etc. See, these kind of assets can be converted into cash within an accounting year without any diminution or reduction in its value, and it is not going to to convert them into cash. It's not going to disturb the operations of the firm. So therefore such assets are called as current assets. Now current liability. Current liabilities again, okay, their maturity is not more than 1 year. They are supposed to be repaid within one accounting year. Okay, fine. Current liabilities are those liabilities which are intended at their inception to be paid in the ordinary course of business within a year out of the current assets or the earnings of the firm. See, these are the liabilities which are supposed to be repaid within an accounting year, and this can be paid out of the current assets or by using the earnings of the company. See, these are the examples for current liabilities: sundry creditors, short-term loans, provisions, bank overdraft, or short-term loan. Yeah, I've already mentioned short-term loans, etc. These are called as current liabilities. So here is an example. Say the company has a balance sheet of this kind, and the total of the balance sheet is 8 lakh each. Fixed assets 5 lakh, current assets 3 lakh, equity capital 4 lakh, debentures 3 lakh, and current liabilities 1 lakh. And the total of the balance sheet is 8 lakh. Out of the total current assets of rupees 3 lakh, only rupees 1 lakh is financed by current liabilities, and the remaining 2 lakh is financed by long-term funds. Hence, the net working capital is 2 lakh. Look at here. This is the total current assets. So, out of 3 lakh, 1 lakh is financed by current liabilities, and the remaining 2 lakh is financed by long-term funds. So, therefore, current assets, look at the first definition. Current assets minus current liability. 3 lakh minus 1 lakh is equal to 2 lakh. The other one is the amount of current assets which is financed by long-term funds. Look at here. 3 lakh, out of 3 lakh, 1 lakh is financed by current liabilities, and the remaining 2 lakh is financed by long-term funds. So therefore that is another definition. Now let us move on to discuss the types of working capital. Okay, the first type is permanent working capital. Okay, it's somewhat fixed in nature. It is the amount of capital supposed to be invested in current assets as a permanent investment. So they are not going to vary according to the changes in the production or sales. So it will not change according to the demand conditions or according to the changes in the season. So they are not seasonal in nature, and therefore they are called as permanent working capital, and they are similar to the fixed assets. As we all know, fixed assets, they are not going to vary according to the demand conditions or according to the season. Similarly, permanent working capital is also like that. They are not going to vary according to the demand conditions as well as changes in the season. The second one is temporary working capital. Look at here. Temporary working capital are those working capital. They vary according to the changes or according to the changes in the demand. Okay, they are going to vary according to changes in the demand or according to the season. Okay, so they are called as temporary working capital. Look at the diagram, so where we can easily understand what do you mean by permanent working capital and temporary working capital. In the x-axis time is shown, and in the y-axis amount of working capital is shown. Okay, look at here. So this is called as permanent working capital. Okay, see, this part is called as permanent working capital. From here to here, of course, as the years move, so, as the company grows, even permanent working capital need to be improved or increased. So therefore, but they are not going to vary. There, see, look at this line. There is no fluctuation in this. So this is a very straight line. Okay, fine. So this is called as permanent working capital. And the next one is temporary working capital. So this is called as temporary working capital. So see, look at here, there is a fluctuation. They varies according to the demand. When there is huge demand, then you need to invest too much or like more on temporary working capital, and when there is no demand, it would be zero, the temporary working capital, or it would be very less actually. Okay, it varies according to the demand conditions or according to the changes in the season. Now let us discuss how to estimate working capital requirement. Okay, there are different methods. The first method is components of working capital method. Second one is percent of sales approach, and the third one is operating cycle approach. So among these three, the first one is and the third one are very important. Okay, now first one on the first basis, estimation of working capital on the basis of components of working capital. The first one is raw materials inventory. Okay, so here how do you find out the raw material inventory? So this is the formula. One of the components of working capital is raw materials, that is closing stock. So in that there are different types of closing stock. So closing stock of raw materials, closing stock of work in progress, and closing stock of finished goods. Now let us take up the first one, that is raw materials. Okay, the stock of raw materials. How do you find out the stock of raw materials? This is the formula. Budgeted production in units into cost of raw materials per unit multiplied by average holding period, inventory holding period, divided by 12 months or 365 days, depends upon the holding period. For example, if the holding period is given in months, then we have to divide it by 12 months, and if they are given in days, then this numerator need to be divided by 365 days. Okay, now budgeted production. This is the estimated production for the year multiplied by cost of raw materials. This we all know. So per unit, what is the cost, multiplied by average inventory holding period. For how many days the inventories are held in the storeroom. Okay, storeroom, and that is called as average inventory holding period. So when you do apply this formula, you get the raw materials inventory. The next kind of raw material is the closing stock is closing stock of work in progress. Okay, so now let us find out the formula to calculate the work in progress inventory. Same formula with minor difference. Instead of raw materials, it is work in progress. So here also divided by 12 months divided by 365 days. Okay, next one is finished goods inventory. So here also the formula is somewhat similar. See, here budgeted production in units into cost of goods produced per unit excluding depreciation. Depreciation supposed to be excluded. So in the case of raw materials, we have taken cost of raw materials per unit, but here it is cost of production goods produced per unit into finished goods holding period divided by 365 days or 12 months, depends upon the information given. The next one is debtors. Okay, now we have completed the inventory, the first kind of closing stock, the current asset. Second one is debtors. We have started from the least liquid. The least liquid, the current asset is inventory, and next least liquid current asset is debtors. How do you find out the debtors from the given information? Okay, now budgeted credit sales, because credit sales is the reason for creation of debtors, or like debtors are created because of credit sales. Okay, budgeted credit sales in units multiplied by cost of sales per unit, not cost of production, of course, here also excluding depreciation, into average debt collection period, how many days the company is going to take to collect the debt, divided by 12 months or 365 days. The next kind of working capital component is trade creditors. So trade creditors is one of the current liabilities. How do you find out the trade creditors? So budgeted yearly production in units into raw materials required per unit. Okay, so here this is the formula, into credit period allowed by creditors. So budgeted yearly production into cost of raw materials required per unit into credit period allowed by creditors. So here budgeted yearly production into cost of raw materials per unit into credit period allowed by creditors divided by 12 months or 365 days. Next one is direct wages. So the formula is budgeted yearly production in units into direct labor cost per unit multiplied by average time lag in payment of wages, maybe like outstanding, for how many days it is outstanding, that is called as average time lag, divided by 12 months or 365 days. Next, overheads other than the wages, so other than depreciation and amortization, because they are not going to consider here for the working capital calculation. Budgeted yearly production in units into overhead cost per unit multiplied by average time lag in payment of overheads divided by 12 months. So here overheads means indirect expenses. So indirect expenses are also called as overhead expenses. So overhead cost per unit is supposed to be known, or it has to be calculated, and then it can be used in this formula to calculate the amount of investment in overheads. Then operating cycle, the second important approach to find out the working capital requirement is operating cycle approach. So these are the stages here. The first one is you have to find out the conversion of cash into inventory. Okay, find out the number of days or months required to convert cash into inventory. Second one, after the inventory is purchased, in the sense whatever amount of cash you have, from that you purchase the inventory. So, and that is called as cash into inventory, conversion of cash into inventory. Then after converting cash into inventory, inventory is to be converted into receivables. Okay, that is the second stage. That means you are going to produce it and sell it. You sell it, then you are going to sell it to someone on credit basis. So in such cases, it is going to be converted as receivables. So for that, inventory conversion period can be calculated by using this formula. Inventory conversion period is equal to raw material conversion period plus working capital conversion period plus finished goods conversion period. So with this you get the inventory conversion period. Okay, look at here. First you purchase the raw materials. So here cash is converted into raw materials. Then raw materials are put into the production process so that they are in the work in progress. So it takes some time for get it finished. So once if it is finished, so it becomes finished goods. Okay, finished goods conversion period. So in total it is called as inventory conversion period. So finished goods are sold and it requires some time for selling them. As soon as they produce, they are not going to be sold, so they are supposed to be stored somewhere in the storehouse. So that is called as finished goods conversion period. So here raw materials conversion period can be calculated by applying this formula. Raw material inventory, what is the total amount of investment in raw materials, multiplied by 360 days or 365 days divided by raw material consumption. So total raw material consumption. So this is the formula which can be used for calculating the raw material conversion period. The next one is a work in progress period, conversion period. Work in progress inventory multiplied by 365 days or 360 days in a year divided by cost of production. Similarly, we need to calculate finished goods conversion period. So that is given by this formula. Finished goods inventory, that is closing stock of finished goods, into 365 days or 360 days divided by cost of goods sold. Okay, so these are the three formulas with which you can find out the inventory conversion period. Once if the inventories are converted into receivables, so then the next step is receivables are supposed to be converted into cash. That is nothing but debtors conversion period. We call it as debtors conversion period. Okay, look at the first stage here. Cash is converted in inventory, and in the next stage, inventory is being converted into finished goods, receivables through this process. Okay, fine. So now look at this. Then once if the finished goods are converted into receivables, the next stage is receivables are converted into cash. So that period is called as debtors conversion period, and the formula to calculate that is debtors conversion period is equal to debtors into 360 days divided by credit sales. As we all know, the reason for debtors is credit sales. Look at here, the most important thing you have to remember here is, suppose if the finished goods are sold on cash basis, in such cases this stage is not going to appear. Okay, this stage is not going to appear. Credit sales are the reasons for debtors, so therefore this stage comes only if there is any credit sales. Now let us find out the operating cycle. How do you find out the operating cycle? The first stage of operating cycle is cash. So cash is converted into inventory, and this stage is called as first stage or first phase. Then inventory is converted into receivables through three process. Okay, fine. First they are converted into raw materials. Raw materials conversion period, raw materials are converted into work in progress. Work in progress is converted into finished goods, and finished goods is converted into receivables. Okay, fine. Then receivables are converted, this stage is called as phase 2, and then finally the receivables are converted into cash in the third process. So operating cycle consists of three processes. Phase 1 where cash is converted in inventory, phase 2 where inventory is converted into receivables, and phase 3 receivables are converted into cash. First let us discuss what I mean by cash conversion cycle. Okay, operating cycle, in the previous table, previous slide we have discussed about operating cycle. Here we find out cash conversion cycle. So cash conversion cycle is calculated by applying this formula: operating cycle minus creditors deferral period. So operating cycle is already calculated. From that, so to deduct creditors deferral period, that means how many days credit period is given by your creditors, that is called as creditors deferral period. Creditors deferral period is calculated by applying this formula, that is creditors into 360 days divided by credit purchases. Now let us move on to discuss the importance of working capital management. Why working capital is important. Okay, so let us discuss one by one. First one, to get a higher return on capital. If as a company wanted to get higher return on your investment on capital, then you need to invest sufficient amount in the form of working capital, and these current assets and current liabilities are supposed to be managed very effectively, which will help to improve the return on the capital. For example, if the company doesn't have sufficient amount of investment in the form of current assets, so in such cases it may fail to pay its obligations. Hence the company, it's going to affect the image and goodwill of the company, and it may lose its customers. Hence it would lead to operational inefficiency. So similarly, if the company has invested too much amount of investment in the form of current assets, again too much amount of investment in current assets is not good, because investments in current assets is a dead investment. It is not going to give any kind of return. So hence, only the required amount need to be invested in the form of current assets. Too much amount of investment in current assets is going to reduce the return on capital. So therefore a proper measure has to be taken so as to invest only required amount, with which the company can face, or a company can manage its liquidity very effectively. So efficient management of working capital leads to higher return on capital. Next one is improved credit profile and solvency. As I told earlier, when a company has enough cash or other current assets, it may find it very easy to repay all its obligations on time. So company's credit worthiness becomes very solvent or very good, and company becomes very solvent in the long run, in the short run. Next, higher profitability. Yeah, see, too much amount of investment in current asset is going to decrease the profitability. So company need to invest very less amount of investment in the form of current assets, so that it will improve the profitability. It can improve its profitability. Next, higher liquidity. Yes, higher profitability and higher liquidity, they are quite reverse to each other. If a company wanted to have higher liquidity, then it has to invest too much, very high amount of investment in the form of current assets. And if company wanted to have high profitability, then company need to invest very less amount of investment in the form of current assets. So therefore there should be a equilibrium, or there should be a trade-off between these two objectives, profitability and liquidity. So as far as liquidity is concerned, it says that, like, to have a better liquidity, company has to invest very big amount of investment in the form of current assets. Next one is increased business value. Yes, when you are very strong as far as your liquidity is concerned, when you are able to pay your obligations on time, you need not worry, or you need not find it very, you find it very easy to manage your business, and it is very useful for you to create value, or like it is very easy for you to improve the goodwill of your company. So therefore, because of all this, it improves the business value of the firm. Favorable financing conditions. Since working capital, effective or efficient management of working capital enhances the credit worthiness of the company, find it very easy to get the financial assistance from the outside lenders. The next one is uninterrupted production. Yes, suppose if company doesn't have sufficient amount in the form of current assets, say for example in the form of inventory, and if there is any unexpected demand, and if there are no current assets, raw materials in the form of closing stock, then it is going to interrupt the entire production process. The entire production process may get disturbed because of shortage of raw materials. To avoid such problems, company need to take care of the efficient working capital management. Next point is ability to face shocks and peak demand. See, in the previous point only I have explained, when there is an unexpected demand, to meet this unexpected demand, company need to keep some reserve investment in the form of current assets, so that any kind of shocks or peak demand can be faced very effectively. Next one is competitive advantage. When you are strong enough as far as your ability to repay your obligations concerned, you find it very easy to attract the suppliers. You find it easy to get the customers for your products, because of all these reasons, your competitive capacity becomes very good. And of course, I have already mentioned in the first point, efficient management of working capital leads to higher return on capital and higher profitability. So all these will improve the competitive capacity, or competency of the company. Next, improves the goodwill. This point is already explained. So efficient management of working capital improves the goodwill and image of the company. Advantages, cash discount. When company has enough amount of investment in the form of current assets, say for example cash, if someone offers the raw materials at a discount for a large quantity of purchase, company can make use of such benefits or cash discounts, such kind of discounts, see, for that to make use of such cash discounts, company need to have enough cash, because if payment is made on time only, you are getting that cash discount. Okay, so for that sake, or because of that, or to make use of such kind of cash discounts, you need to have enough amount of investment in the form of current assets. Next one is regular payment of wages and salaries. When you doesn't have enough cash, you find it difficult to pay the wages or salaries. Since you are very efficient to manage your working capital, you have enough fund or capital cash to pay your wages and salaries. So that enhances or that improves the commitment of the employees, and it will be very useful to create committed employees to your organization. Next, creates a sense of security and confidence. People are highly secure because they are getting the salaries and wages on time because of very good management of working capital by the company. So it creates a sense of security and confidence in the minds of them. And even more than that, when the company has enough cash in its hand, it finds it very easy to repay all its obligations on time. So there also it creates a kind of security and confidence in the minds of management. Next one, efficient use of fixed assets. See, use of fixed assets, effective or efficient use of fixed assets depends upon working capital management, efficient working capital management. When you have sufficient money in the form of current assets and current assets, you can make use of the fixed assets properly. When you don't have the cash to pay the salary or wages, your employees may go for strikes or lockouts. In such cases, the production may get disturbed, and during the time of strikes or lockouts, these fixed assets are going to become useless, or like they are not going to be used. So therefore, inefficient use of fixed assets. Okay, see, this kind of liquidity problem leads to ineffective or inefficient use of fixed assets. So therefore, for the purpose of efficient use of fixed assets, you need to have sufficient amount of investment in the form of working capital. Then timely payment of dividend. Yes, payment of cash dividend depends upon the cash reserve of the company. When a company has enough cash in its hand, it can pay the cash dividend. So therefore, that is another importance of working capital management.